All right, let's jump right into it. Today's explainer is all about unpacking A10 Networks' Q1 2026 financial results to see exactly how this massive AI and cybersecurity boom is playing out in the raw numbers. If you've been watching the tech markets lately, you know the narrative is obsessively focused on AI hardware and infrastructure. But behind the scenes, securing and actually optimizing that infrastructure is where the real, critical business battles are happening. So we're going to use the hard data from A10's recent earnings to figure out how a company actually rides out an unprecedented tech wave like this.
We've broken down today's explainer into 5 quick stages: the macro hook, the engine, the steering, the roadblocks, and finally, outlook and future durability. Let's get to it.
Section 1. The macro hook, catalyst for the boom.
To really understand A10 Networks right now, we have to start with a multi-million-dollar question. How exactly is the AI boom reshaping cybersecurity infrastructure? You see, standing up these massive AI clusters isn't just about plugging in faster processors. It demands an entirely new level of data throughput, network performance, and honestly, rock-solid security to protect some incredibly sensitive AI workloads.
Now, what's really wild here is how the cybersecurity sector has completely decoupled from broader software. While the general software index took a major hit, dropping over 30% in Q1 2026 due to AI disruption fears, cybersecurity proved it's basically non-discretionary. Companies literally cannot hit pause on their security spending while they're rushing to build out AI capabilities, especially with rising geopolitical risks. And that resilience, it's a massive, massive tailwind for A10.
CEO Dhrupad Trivedi totally hit the nail on the head regarding this shift. He pointed out that your standard, everyday enterprises are suddenly facing hyperscale-level networking challenges because of AI. A traditional corporate network just doesn't cut it anymore. The lines are blurring, and regular enterprises suddenly need the heavy-duty, service provider-grade solutions that A10 is known for.
Section 2. The engine, Q1 2026 financial snapshot. Opening up A10's financial hood, we can ground ourselves in the actual GAAP filings. They pulled in $75 million in total net revenue for the quarter ending March 31st, 2026. Now, that is a direct result of their targeted focus on those infrastructure build-outs we were just talking about. But top-line revenue really only tells half the story. The true secret to their business model is actually hiding a few lines further down the income statement.
And here it is, this incredibly high 80.6% non-GAAP gross margin. This proves they are running a highly profitable premium operation that can easily absorb market shocks. When you're selling highly specialized hardware and software into critical infrastructure, you've got pricing power. An 80.6% margin literally means that for every dollar they bring in, they keep over 80 cents to cover operating expenses and drive profit. That is a seriously healthy buffer.
On top of that, their adjusted EBITDA margin hit an impressive 30%, which translates to $22.5 million for the quarter. This metric strips out all the non-cash expenses, like stock-based compensation, giving us a crystal-clear picture of the cash-generating power of their day-to-day operations. A 30% margin shows immense operating leverage.
So if you add that 30% EBITDA margin to their guided 10 to 12% annual growth, you see exactly how they hit the coveted Rule of 40. This is basically the gold standard for financial analysts looking at tech companies. It means you can sacrifice a little growth if you're incredibly profitable, or vice versa. By hitting 40 to 42%, A10 puts themselves in a really elite category of efficient operators who balance solid growth with sustained cash generation.
Moving on to Section 3, the steering, the enterprise sales pivot.
So the engine is strong, but how are they actually capturing these margins? Well, we're seeing a massive strategic pivot. Direct enterprise sales now make up 56% of their revenue at $42.2 million. Historically, telecom and big service providers were the ones buying these giant networking solutions. But remember that CEO quote, "Modern enterprises are building their own private AI data centers now, and A10 has successfully steered their sales team right into that lucrative new demand." And how do they win over these enterprises? By offering one unified architecture that scales equally well for a corporate client or a massive telecom provider. Instead of juggling completely separate product lines, A10 uses a common policy engine and a shared operating system. It's an incredible competitive advantage. It keeps their R&D costs down while letting a mid-sized enterprise tap into the exact same security framework used by global service providers.
Okay, Section 4, the roadblocks, supply risks, and headwinds.
No business operates in a vacuum, right? We have to objectively look at A10's vulnerabilities. A major physical roadblock right now is the global shortage and cost spike of DDR memory,
which management expects is going to remain tight for at least 4 quarters. These memory chips are the absolute lifeblood of fast networking equipment. When those costs spike, it's a direct threat to that beautiful 80.6% gross margin we saw earlier. It's a critical supply chain risk to watch. Beyond just the hardware costs, they are also fighting some tough geopolitical headwinds. You've got regional conflicts in EMEA, which makes up about 14% of their revenue, and you've got delayed, highly conservative spending from the Asia-Pacific market. Companies there are just holding on to their cash right now. It really shows that A10 is still heavily relying on the U.S. enterprise market to keep this momentum going.
Finally, Section 5, Outlook and Future Durability.
Even with those roadblocks, A10's management is confidently guiding for a 10 to 12% top-line revenue growth for the full 2026 fiscal year. They are banking on the sheer scale of the current AI build-out phase. They're taking market share, and their full-year free cash flow expectations aren't just stable, they're actually expected to expand year over year.
But here's the ultimate test. Can they convert these massive, lumpy AI hardware sales into sticky, recurring software subscriptions? A10 currently has a very healthy $147.2 million in deferred revenue, but right now, their demand is driven by big, one-off capital expenditures. To be truly durable long-term, they have to attach ongoing security subscriptions to those big hardware boxes they're moving today.
And that brings us to their overarching strategy, balancing targeted revenue growth with incredibly strict capital allocation. For example, they returned $6.8 million to shareholders this quarter alone, $4.3 million in cash dividends, and $2.5 million in share buybacks. This is a management team that isn't just blindly chasing growth. They are hyper-focused on disciplined profitability and taking care of their shareholders.
As we wrap up this explainer, I want to leave you with one big thought to monitor going into their next earnings cycle. Can they smoothly transform today's hardware boom into tomorrow's software stability? The AI infrastructure build-out is a massive wave, and A10 is surfing it perfectly right now with a sharp pivot to the enterprise. But the true winners will be the ones who remain indispensable long after the data centers are built. Thanks for learning with me today, and definitely keep asking the right questions.